All right, well, I want to welcome you to this Strategic Partner Program presentation. My name is Kurt Naderveld. I am the CEO of Rainstar Capital Group, and if you are watching this presentation, you either are, online, maybe on our website, taking a peek at it, or possibly one of our managing directors has sent this to you. I'm excited today to be able to, kind of do a deep dive into our lending platform and how it is that we can add value to you as one of our strategic partners. So here at Rainstar, we have built kind of one of the leading debt advisory platforms here in the U.S. As of the shooting of this video, our firm, has a national presence. We currently are at 35 managing directors spread out across the United States. All of our managing directors have anywhere from 10 to 40 plus years of experience, either in commercial real estate, ABL, equipment, or also like corporate financing. And so our team, we've been really blessed here at Rainstar to have a very strong team, and that plays a big factor when you refer a client in a transaction over to us, because of the fact that our folks have the ability to, have that level of expertise to be able to walk them through and identify for them which of our product lines is going to be a good fit. And so from a lending perspective, we've built one of the more robust debt advisory platforms. We have 250 registered lenders on our platform. To make our platform very simple, we finance clients in first and second lien debt positions from $10,000 to $100 million across the four major food groups, commercial real estate, corporate finance, small business, and equipment financing. And we've worked really hard to bring on a lot of different lenders that pretty much cover all of the interest rate boxes and all of the credit boxes, okay? You can kind of see listed there all the different products. We're gonna go through that a little later in the presentation. And so, as we continue on with the presentation, our lenders are not high net worth individuals or like private individuals. All of our lenders are big funds, right? Or big branded lenders, okay? Typically, the majority of all of our lenders have at least 50 million of assets under management or more. And our lenders are primarily either banks, hedge funds, private equity firms, equipment finance groups, specialty finance firms. We have pension funds, agency lenders, obviously, for commercial real estate, insurance companies that put capital against commercial real estate. We also have bridge lenders. Then we've also really built out a very strong fintech platform, which we'll kind of talk about when we go through the working capital platform. The fintech lenders to us are completely where it's at. What they've done, obviously, is they've married up technology, with financial lending, and it's awesome because they have the ability to streamline the process of a client being able to get capital in an expedited manner. Okay, so as a partner, we also have really focused, and we get applauded for our focus on two things: education and then also transparency. And so from an education perspective, we built our own digital magazine called Rainstar Capital Group's Ultimate Lending Guide. And the magazine has been a huge addition for our business. Our clients and partners really like it because the magazine highlights all 250 plus of our lenders programs. So it's not just us telling you that we have these lenders. We actually had our team, it took our team about 4 months to build. And we went through all the different matrices of every single one of our lenders, and then we compiled that into an easy-to-use magazine that then shows you all of kind of what's behind us, basically, right? So you can see each one of the lenders' profiles. We break it down for you, showing you what the minimax rates are, what the minimax loan amounts are, where they lend, what types of products they have, what types of deals that they do. So I would encourage you to take a minute, go check out our capital market section of our website, or we also have the magazine at RainstarUltimateLendingGuide.com. And a lot of clients and partners really appreciate it. And to be honest with you, they're coming back with us, and let's say they're looking to refinance their $8 million office building, or they're looking to purchase $500,000 of equipment. Now they can just go into the commercial real estate section of the magazine, and they can come back and say, well, hey, I think equipment lender number 7, 13, and 25 would be a great fit for my deal. So I highly encourage you as a partner, go check out the Ultimate Lending Guide. I think you'll like what you see. Along with that, on the magazine, we also highlight all 250 plus of our lenders on the capital market section of our website. So you can see kind of there, if you go to the capital market section of the website, you'll be able to click into the different sections like asset-based lending or purchase order finance or equipment finance, whatever the section is, and go check it out there. The same lenders that are on the magazine are also on the capital market section of our website as well. So One of the other things that we've done really well that partners appreciate is that we've really done a good job of identifying lenders that fit specific niches. So, and then we've been able to kind of brand out their products in a manner that really attracts clients to us. And so some of our flagship programs are our no credit check credit line. We also have our cash credit line. We've got a very popular no credit check, no income check equipment financing program that's for deal sizes of 200,000 to 50 million. We also have a 4-hour equipment funding program for our business loan program. We can fund clients, same day or, typically within, 24 hours or so. Commercial real estate bridge loans are very popular. We also have a business credit card program. We also have a very popular 48-hour business term loan as well. So a lot of those programs, again, are on our website, and you'll be able to go, check that out. Along with the products, we also here at Rainstar are very process focused. And so we've developed what's called our working capital blueprints. The working capital blueprints is essentially the process that we walk a client through to identify where it is that we're going to get them leverage, okay? And so as you can see there, obviously if you look at the top left, the lowest cost of debt always for a client, doesn't matter what the product line, comes from a bank, right? And typically a bank is going to give them capital in the form of an SBA loan, a term loan, a conventional term loan, or a revolving line of credit. And so we can provide that with our platform. And then also if a client can't get financing from a bank, we have then these fintech lenders that will provide lines of credit and term loans that essentially can either replace the bank debt or for growing companies, these products will take a second lien position behind the existing bank debt, which is a very powerful proposition to a client, especially if they're in growth mode, right? They need additional access to liquidity. And if the bank is kind of hitting their ceiling, that's where these fintech lenders can kind of take over. From there, so the first 3 buckets kind of leverage up their cash flow, right? And then from there, we'll do the analysis, look at their commercial real estate, see if there's any sort of cash out refinance, or if maybe they need help purchasing their office building, and we can help on the commercial real estate side. Then we'll take a look at their equipment situation, see if we can do a cash out refinance against maybe some of the equity they have in the equipment they own, or if they need to purchase new equipment. From there, we'll see if they have any outstanding AR, accounts receivables, purchase orders funding. We also kind of lump inventory into there. So if they have inventory, we've got really great inventory financing solutions. And finally, we have what's called our business and personal credit card program. We can get clients up to 150,000 or so in these business and personal credit cards. So that's kind of the process that we walk a client through, and it really helps to give that visual to the client to help them understand what it is that they qualify for. And then along with that, we have built out industry specific working capital blueprints. So if you take, for example, a manufacturing firm, they have different nuances or different needs than say a staffing firm, for example, right? And so one of the things that especially a lot of our banking partners appreciate and other CFO advisory and other management consultants is not only do we have these general blueprints, but we also have it industry specific, and partners really like that, and clients do as well, right? Because that they know that we understand their business, right? We know that, for example, a manufacturing firm is going to have really heavy equipment needs, right? We know that a staffing firm probably is not going to have heavy equipment needs. They just need their office, cubicles, right? So clients really appreciate the fact that we understand and know their business. And then again, we have the lending platform behind us to be able to match the products to meet their needs based on the 3 C's, of course, cash flow, credit, and collateral. And so when we look at our platform, again, the 4 major food groups, or what we call the 4 chessboards, commercial real estate, corporate finance, working capital, and equipment. One of the things that we try to get across to partners is that each of the chessboards has different pros and cons. And what we mean by that is commercial real estate, for example, is a great solution, but those deals are going to take 2 to 6 weeks, right? We're not funding a commercial real estate deal in 48 hours, right? So there's a time frame that it takes to get that deal done. Second, obviously commercial real estate, it's a function of the appraisal value, right? So each of the chessboards has kind of different pros and cons. And that's one of the things that your managing director will kind of walk you through and help you understand from a closing perspective, the time it takes and kind of what some of the the hindrances are in regards to getting deals closed. So now what I want to do is kind of take each one of these chessboards or each one of these categories of funding and kind of walk you through and help you give you an understanding of who, what our lenders provide. And so each of these sections, we kind of break it down in some different, categories and different slides here. So we're going to start out in helping you as the partner understand when it comes to working capital for a client, what are the rates, right? What does the rate hierarchy look like? Again, our goal is, of course, to get the client the lowest cost of capital. But the reason that sometimes the interest rates go higher is going to be, of course, based on credit, based on year in business, based on the overall revenues of the client, right? The strength of those revenues, right? So when you look at, where do we get that lowest cost capital? That's always going to come from a bank, right? So typically we can finance clients from a bank loan or a term product revolving line of credit from $25,000 to $50 million. Banks typically give out capital at 4 to 7%. Okay. If a client can't get funded from a bank, what that means again is then they have to go down the working capital blueprint and they have to then get some sort of fintech term loan, right, or a fintech line of credit. Typically, we fund clients from $10,000 to $5 million on the term loans. Our line of credit providers that just go against cash flow typically go up to about $250,000 or so. Rates in the term loans typically are going to be like 8 to 20% or so. We typically see the lenders putting out money like in the low teens on that product. For the lines of credit, typically those are like 12 to 24%. Again, though, those are powerful, those lines of credit, because they take second lien position and the client controls the interest they pay, right? Meaning, it's a revolving line of credit. They only pay interest on the money if they actually use it, okay? From there, if we can't get a client into a fintech term loan or line of credit, we have to go down, the hierarchy and go to the next product, which is our A-paper advances. Advances sometimes can be a dirty word because of the fact that they have like a daily repayment, right? Sometimes a weekly repayment, and they can be very they can be very costly, right? There are times when obviously they're needed, right? And one of the things I want to get across is that an A-paper advance, the rates can be anywhere from 18 to 40%. They can go out anywhere from 1 to 2 year terms. Obviously higher cost of capital, right? But sometimes I think when people look at the merchant cash advance space, they only think of the final section, which is, the B, C, and D paper, where it's all 40 to 150% rates. It's super expensive capital, right? But the nice thing is there is a niche in there called the A-paper advances that, again, it's higher cost of capital, but for a client that can't access a fintech term loan or line of credit, it still is a good solution, right? So in our world on the working capital side, to be able to get a client capital just against their cash flow, we can only deal with clients doing a minimum of $200,000 of annual revenue, and they must have at least a 500 credit score, okay? Ideally, though, we want to deal with, larger clients, right? 200,000 is definitely the low end of the spectrum. I mean, if I were you as a partner, I would really, to be honest with you, only want you referring more over companies doing at least $500,000 and ideally, kind of 1 million or more, okay? So going on then, let's talk a little bit about what are some of the deal killers when it comes to working capital deals. Hands down, the number one thing that kills a lot of the deals are cash flow, okay? Cash flow is hands down number one, okay? When our lenders go to lend against, for like a $50,000 line term loan or line of credit, again, what they're looking at is the bank statements, right? And they're going to look at, is there enough minimum deposits? Typically, you need to have 5 on a monthly basis. So as a partner, it's a really big deal. If you bring us a term loan, line of credit request, check the bank statements. Check to see that they have a minimum of 5 deposits, because you could have a company doing $5 million of revenue, but if they only have 2 deposits, the lenders are going to look at that as kind of risky from the perspective of, well, what happens if they lose one of those clients and that deposit is not there, okay? Another big thing is how much cash balances do they keep on a daily basis, right? They need to have at least 2,000. So again, when you look at the bank statements, if you see that they have a bunch of NSFs, right, or defaults where the balance on their account has gone below 0, that's not a good thing, right? So again, another thing that kills the deal is too low of a credit score. And then finally, of course, is the debt service coverage doesn't work, okay? So there's 7 power questions when you come into a contact with a client that you have to ask to help kind of figure out if they're a fit. Okay, first is, what is the product request? Second is, what's the loan amount? Third is, what's their credit score? Fourth is the geographic location. 5 is the type of business. 6 is, what is the minimum number of monthly deposits? And finally, what is their annual revenue, okay? When you ask those questions, what you're looking for, obviously, the loan request size has to be 10,000 to 50 million. again, to kind of give you some context, we can only get clients typically, bank debt if they have like 700, sometimes 680 plus credit score, right? Then for term loans, typically it's like a 640 plus score, and then everything below a 640, that means we're going into the advanced world, okay? Again, big thing, they need to get 5 deposits on a monthly basis, and they must be doing a minimum of 200,000 annual revenue. Now, I want you to, if you have a pen and paper right now, write this down, okay? This ratio is a huge ratio that is really gonna help you to understand what is the amount that the business owner is gonna qualify for. Typically, when you look across all of our lenders, across all the capital markets for cash flow products alone, typically the lenders give out 1 to 10% of gross annual revenue or 1 to 2 times monthly deposits, okay? Write that down, 1 to 10% of gross annual revenue or 1 to 2 times monthly deposits. So what that means is if you bring in a client that does 200,000 of revenue and they're asking for 100,000 as a term loan, no one's ever going to do that if there's no collateral, right? Because they're asking for 50% of their gross annual revenue, right? So typically, if a client's doing 200,000, they're going to get 2 to 20,000. Okay, they do $500,000, it's going to be 5 to 500,000. If it's $1 million, it's going to be 10 to 100,000. Okay, that is the metric, and that's a huge thing that a lot of our partners don't know. But now that you've watched this presentation, I want you to write that down because it is strictly against a cash flow solution on the working capital side. That normally is what a lot of these working capital lenders are going to give. Okay, so as you can see, the documents that we need, you can click through. That's our submission portal. That's obviously mine, but you can go to each of our managing directors to check out their submission portal. And again, you can kind of see the breakdown. Working capital is pretty simple. We just need a signed application, credit report. If you have the tax returns, that's beneficial. We don't always need those. That just helps to give kind of a complete file. For sure need a year-to-date P&L and balance sheet. Also need the last 6 months business bank statements because obviously cash flow, as we talked about, is a big thing to the working capital lenders. If you have a debt schedule with a breakdown of their existing debts, that's very beneficial. Also, if you have an outstanding AR, accounts payable report, that's beneficial as well. Okay, so that kind of wraps up working capital. Again, these products that we just talked about primarily provided by like fintech lenders, banks, and advanced lenders, and they just lean against the cash flow of the business. They're not tying up or encumbering the real estate, the equipment, the inventory, or the AR. What we've just described on this working capital section is just against cash flow. Okay. Now we're going to transition on into the ABL, asset-based lending and factoring solutions. Okay. So typically when you look at the products for that, we have our inventory term loan and line of credit, which is obviously where the lenders will put a first lien position on the inventory. Second, we have purchase order financing. Third, we have accounts receivable factoring. Fourth is we have an accounts receivable line of credit, which is really interesting. I'll touch base on that in a minute. Then we have equipment, and then we also have the overall ABL solution where the lenders that do those are going to lean against multiple asset classes. So they might lean against the inventory, AR, equipment, etc. Okay. Now, one of the important things, and this kind of gets into, again, how do you figure out how much the client's going to qualify for? Okay. Typically, when it comes to inventory, the lenders will give a max advance rate of about 80% of the overall value. A lot of the lenders will look at not appraised value, but what's called forced liquidation value, which is basically if they have to fire sale it, right, or sell it at auction, what's the value that they can get, okay? Purchase order financing, again, they'll typically go up to 80% of the outstanding PO. A lot of the lenders obviously are going to look at the strength of who is buying that product. So obviously if it's a Costco or a Walmart or a strong buyer with a great credit, that's a good thing, right? That's very positive, okay? With accounts receivables financing, again, those lenders that do factoring are going to typically max out at about 95%. Accounts receivable factoring is where the lender purchases the invoice, right? And they give you, the client, the advance. Now, what we have on our platform that's really interesting is we have a product that's actually replacing factoring called our AR lines of credit. What's powerful about these lines of credit, it's provided by a fintech lender, is that it's non-notifying, okay? So typically in factoring, the clients know that the client of the lender is getting some sort of financing or factoring, right? Because the factoring firm begins to collect all the payments of what's due 30, 60, 90 days later from the buyer of the product, right? And so what's powerful about this AR line of credit is that it's non-notifying, meaning that the clients never know that they have financing involved. And what they do is that it's a max advance rate of 90%, and they basically lean up against the AR, but they're not purchasing the receivables. And they give our clients a revolving line of credit. Typically the deal sizes on those are 200,000 to 20 million. Powerful product. Rates are like 8 to 20%. A huge product line that we're really pushing here at Rainstar because it replaces factoring and it has just so many different benefits compared to traditional factoring. So along with that, we have equipment, max advance rates of those, and an ABL solution go up to 80%. I'll talk about equipment later on. We can go all the way up to 100% if it's on a purchase. And then finally, kind of a blanket max rate that anyone in the ABL space does on the high end. It's going to be 90% of AR, 80% of inventory, 80% of PO, and 70% of equipment. Okay, that's at a max rate. Typically, you'll see though lenders doing maybe like 80% of AR, maybe they'll go 60% of the inventory, 70%, 50% of equipment. It depends on the lender. Okay, so that will help you understand kind of the amounts that a client is going to get. Okay. Again, when you look at, what are the interest rates that those lenders typically put their capital out at? Again, deal sizes for inventory and the line of credit typically going to be 200,000 plus. They want to deal with bigger deals, and typically rates are all going to be like 15% plus on inventory. Okay, from kind of the alternative lenders. Okay, on purchase order, typically deal sizes again need to be 200,000 and up. Typically, the lender is going to take 1 to 5 points of the purchase amount, the purchase order amount that they. They're advancing the capital on. Same thing with factoring. Again, the deal sizes on those need to be 25,000 plus. They're going to take anywhere from like 1 to 5 points on the high end as their fee of the amount on a monthly basis of the amount that they're doing in advance on. Okay, the AR lines of credit again are different because they're not purchasing the invoices. They're just giving a line based on the overall borrowing base or receivable base, and so those rates can go anywhere from like 8 to 25%. Equipment can be anywhere from 5 to 30%, depending on if you're using an A paper lender versus B, C, or D. And then ABL solutions typically are in the 8 to 25% range. Okay. We also on our platform, just so you're aware, have international factoring and ABL available. Minimum deal size is at least 1 million. We do not really deal with startups when it comes to international factoring. They need to be doing at least, ideally, like 3 to 5 million plus of revenue or more for us to have an interest in any of our international factoring firms to get involved. The nice thing typically with factoring is that no credit score is required. Obviously, for some of the ABL purchase, or not for sure, but for some of the ABL solutions, they will check credit, but a lot of it is really, what the lenders are looking for is the value of that outstanding outstanding AR. Okay, so the reason that deals typically get killed in ABL and factoring is that the borrower has kind of a higher expectation of an advance rate, right? So it's important that you educate that borrower now that you watch this video on what the advance rates will be. Typically, the issue as well as the quality and the value of the collateral, the strength of the debtors in the AR. That also plays in along with the length of the AR, right? Obviously, if you have AR that's 120 days plus outstanding, that's not a good thing, right? Typically, the AR lenders want to see a 30, 60, 90-day churn, right, where the client is getting paid from their clients. So the Power 7 questions that you need to ask when you are going and getting an ABL deal before you send it to us. What are the, what's the product request? What do they want, right? Is it an inventory deal? Is it a purchase order deal? Is it AR? What's the amount they're looking for? What is the credit score? Where are they located? What type of business is it? What's the type or value of the collateral, right? Is it purchase orders to Costco? Is it receivables to a large energy company? What is it, right? And then what is the annual revenue and EBITDA, okay? Again, what I would encourage you is have these 7 questions out and ask them when you talk to that client before you refer the deal to us. Okay. So what you're looking for again under loan amounts, it needs to be 25,000 plus for AR. It needs to be 200,000 plus for PO, 250 plus for inventory, 500 plus for an ABL solution. Okay. Other things that are important, obviously, on the on the revenue side, they need to do a minimum of 1 million. Minimum of 200,000 of revenue or more. Ideally, we really don't want to be dealing with clients doing $500,000 plus of revenue. That's just more where our lenders want to be dealing with. Okay, you can kind of see the breakdown of the documents they need. What's unique about ABL and factoring is, again, you need all the basic information, but then it's important that if they do have equipment, do have inventory, do have purchase orders, we need to see a breakdown of that. And again, if you go to the submission portal, you'll be able to see the breakdown of what we need for all of our product lines. Okay, so now we transitioned over to commercial real estate. Again, commercial real estate, your A paper debt typically falls between 4 to 7%. That typically is going to come in the form of like an SBA loan, or it's going to come from capital from a bank, a CMBS lender, collateralized mortgage-backed securities, an agency lender. And then from there, we start going down the hierarchy, right, from a rate perspective. So from there, you go into Alt-A lenders. They typically put out capital in the 7 to 9% range. Again, we on our platform have the bridge lenders typically put out money at 1 to 2 years. We've got 5-year money, 10-year money, 30-year money as well across all these products, okay? Non-bank SBA, again, 6 to 9%, up to 30-year money. Cheap bridge money and hard money bridge, those typically are going to be, again, 1 to 2 year terms. The max I think that we have is a 3-year term, but normally the bridge lenders put capital out 1 to 2 years, okay? Commercial real estate, again, there's a lot of reasons that deals get killed in commercial real estate, okay? And the biggest one is the borrowers always want too high of an loan to value, LTV request. They always think their buildings appraised, the appraisal on or the value of is more than what, the lender's appraisals come back at, right? So it's a function of valuation, right? Another big problem in commercial real estate is obviously the lack of down payment money and the liquidity, right, that's needed to, get a 70% first lien position mortgage, compared to just having 20% down to get 80. Again, a big thing too, lack of borrower net worth, right? That's a big thing. Too low of credit score, and then obviously debt service coverage doesn't work on the property, right? So the cash flow stream from the tenants or the renters doesn't meet the interest payments of the loan, right? So your 7 power questions that you need to ask when you're dealing with this type of client is, what is the project or the property type? What is the loan amount they're requesting? Where's the credit score? What's the address of the property? That's really big. We need to know the address. Is it a purchase, refinance, or new construction transaction? What's the LTV of the request? And then finally, what is the net worth and track record of the borrower? Okay. So when you ask these questions, okay, let's go through kind of what's more mainstream versus what is tougher to do. Okay. So number one, the property type. The mainstream types of deals are hotels, multifamily, office, industrial, retail, kind of the 4 major food groups. The big thing on those is they typically all are cash flowing, right? They've got very strong cash flow to handle the debt service coverage ratio. And so where you start to get into tougher, but what we call doable deals, land is hands down a tougher one. We have a lot of land lenders, but they typically go 40, 50, max of 60% LTV, right? Because there's no cash flow when it comes to land, right? And so there's a risk there, right? New construction deals, we have a lot of new construction lenders. Again, problem with that is there's a risk period, right? There's a time period where the borrower has to build, construct the hotel or construct the office complex. There's no cash flow coming in, okay? That can cause issues, right? And then you get into what we call special use properties, right? So marinas, golf courses, gas stations, convenience stores, funeral homes, resorts, and single use and special use properties. The reason behind that, just think about it, right? If a lender has to foreclose on a marina, it's not like there's a million real estate investors that want to come buy a marina. Why? Because a marina has a special, you have to have a person that buys it that's what's, like a special operator, right? There's an operational aspect to that business, same like a golf course, right? You have to have someone that knows how to run a golf course because there's a business on that property, okay? The deal sizes that we do then are from 100,000 to 100 million. They have to have a 500 plus credit score, okay? Credit is important, but we also have collateral lenders that will underwrite the properties. Just understand the rates that those lenders put capital out on are going to be higher, obviously, compared to someone that qualifies for low interest rate debt because they've got great net worth, great credit score, great track record. You're dealing with more of a collateral lender at that point. Again, all lenders want to lend on properties that if they have to take back, they want the ability to sell, right? So from a geography perspective, again, if you have a town that has 20,000 people in it, that's going to be tough compared to New York City, right? The appetite for buying the property that the lender forecloses on New York City, there's a huge plethora of buyers that are going to want to buy that compared to, if you're out in, in a rural area of Iowa, for example. Okay. Again, what's the deal? Is it purchase, refinance, or new construction, right? LTV, sweet spot, of course, across the board is going to be 70 or lower. And then when it comes to net worth and track record of the borrower, obviously the lenders want to see if the borrower knows what they're doing, that they're not a rookie, just starting out. Okay. So again, these are things that are going to kill deals, right? If you have a deal out in Iowa, or if you have not necessarily just Iowa, if you have a deal out in a rural area, it's going to be tough, right? Not a lot of lenders will want to do that deal. If you have a deal that doesn't have strong cash flow, if it's just a land deal, right? It's not that it's not doable. It's just that, it's tougher to get done, okay? You can read through all the documents there that you have to get. I'm not going to verbally go through it, but obviously with real estate, there's a fair amount of documentation that needs to come in. So please make sure, especially with real estate deals, that you follow this list and get a very full picture of the property, of the borrower, so that when you bring the deal to us, our lenders can make a decision fairly quickly. Okay. Now we're going to transition into equipment. Okay. Again, on our platform, we have lenders that will provide bank debt, which typically gets put out in the 5 to 8% range. We have these Alt-A lenders, right, who, if you can't qualify for bank debt, will give out money in the 7 to 9% range. Especially finance firms, they typically put money out to 8-20%. And then we have what we call expensive lenders, which are lenders that maybe are more collateral based. They're not going to underwrite as much the cash flow, or maybe they're dealing more with borrowers that have worse credit. They put capital out at 20% plus. Okay. Main reasons that equipment deals get killed, kind of similar to real estate. Too high of an LTV request. The borrower doesn't have has a lack of a down payment money. The borrower does not have the requisite financial standing or net worth to qualify for the truck. Let's say they're buying a Peterbilt truck, or they're looking to buy some sort of medical equipment. Again, if they're starting out a business, lack of personal income and experience for the startups is always tougher, right? In the trucking space, a lot of the truck lenders, since the truck's always on the road, which means there's a risk from the perspective of the truck's always moving, they like to know that there's, that the borrower has a home that they own. So there's a whole different factors when it comes to, equipment. Again, what you need to look at for the Power 7 question is, what type of business is it? Is it a doctor's office? Is it a trucking firm? Is it a farm, right? What is it that they're buying, right? Or excuse me, what is it, the type of business that they are? And then, what type of equipment are they buying, right? Then you have to know what the loan amount is, the credit score, where the business is located, the equipment, where it'll be stored. Is it a purchase or cash out refi? Also, then you're looking at the LTV of the request. And the big thing, of course, is, again, cash flow. What are the annual revenues? Okay. So when you talk to a client, what you're looking for is deal sizes from 10,000 to 50 million. They have to have a 500 credit score. And then from an LTV perspective, we can go up to 100%, through a lease, but again, that's going to depend on credit. Okay. We can do startups, but again, we ideally want to be dealing with folks that are doing at least 200,000 more of revenue. Okay. One of the things I want to reiterate, similar to working capital, number one deal killer in equipment financing is cash flow. Okay. So it's always about cash flow, how much down payment month they have, the credit score. When our directors take the deal from you and work with our lenders, these are the things that we're dealing with on our end. Okay. In regards to the documents that are needed, again, we need pretty basic: signed application, credit report, 6 months business bank statements. We need a quote and an invoice of the equipment that's being purchased from the vendor, right? So if they're buying a truck, get the the semi-truck information from the dealership, or if they're buying medical equipment, get it from the manufacturer. That's what the lender needs to be able to see. Okay. If they own any existing equipment, we're looking to do some sort of cash out refinance or cross collateralization via the new equipment and existing equipment. Need an equipment list. And then finally, we also need a debt schedule that shows the existing debt on that, on that equipment. Okay. So when it comes to equipment, a lot of businesses need equipment. We're very active in equipment, but these are some of the important things that you as our partner have to be on the lookout for. Okay. So with that being said, one of our biggest goals, see the whole point, right? If you're watching this video at this point, the whole goal, right, is to close transactions, right? The whole goal is to be able to serve clients, help them with their financing needs. The battle becomes in this space, that's the goal, but the battle is what I call putting the pieces of the puzzle together, right? So hopefully by watching this presentation, this will hopefully help you to understand how to get to a fast no, okay? The other thing that's important, obviously, is you have to get full packages, okay? We cannot help you as our partner and help your client if you do not get full documentation and paperwork over to us, okay? We developed then the Power 7 questions, to be able to kind of give a quick snapshot, right? So when you send over the deal to us, what you have to do is get the full package by following our submission portal. Second, you need to get the Power 7 questions answered. You'll email that to your managing director here at Rainstar in the body of the email. And then along with that, you will personally introduce the client to your Rainstar director, via email. We're really big. Our platform primarily is built off of referrals, right? And so we ask and request that our partners, email connect our directors to that borrower. Okay. The reason that we then have all these systems, right? The working capital blueprint, the submission portals, right? Again, this business is a great business. Getting financing can go very quickly, but the problem is if you don't have these systems, you run into a battle of time and headache. Okay. So hopefully by watching this presentation, you've been able to see how we can together work as a team, and we can focus on saving time by following our blueprint, okay? And the blueprint then is the roadmap that walks us through getting to the end result. And here at Rainstar, we have a phrase we call "make it rain," right? Which is obviously serving clients, getting deals closed, and getting new loans into our lenders' portfolios. So I'm excited to have you as a partner. Thank you so much. We're very honored and blessed to have you. And we just ask that you would follow these steps, okay? Follow this blueprint, and then we can create a great partnership together, and above all, make it rain. So if you have any questions for me, here's my contact information. I would ask that you work with the managing director that that sent you this presentation. They will obviously are going to be your point person, and they'll have the ability to work with you and your client in regards to getting that client the financing that they need. So thank you so much for watching this presentation. Blessings to you and your family, and we'll look forward to speaking with you soon. Thank you.